Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. Welcome to a Wiser Retirement Podcast, where we cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith. Guiding you to financial success are my co-hosts, Brad Lyons and Barnett. Hey, guys.
How's it going?
Hi, Casey.
Well, it is time for another topic, and I like this one. Is your behavior affecting your portfolio? And we're going to talk about behavioral finance. You know, a while ago, when we used to go to conferences, there was a guy at the ETF.com conference who was speaking, I think at a lunch breakout session. And, he said, "Hey, I want everyone in the room to raise their hand if they think that they're a good driver." And like almost everybody in the room puts their hands up like, "Yeah, I'm a good driver." He was like, "Well, there's like 2,000 of you here. So statistically, 30% of you have been in or are going to be in a car accident." So he's like, you know, we have biases. We have biases that, oh, we're better than the average, or we're different, or maybe it won't happen to us, or whatever. And that's a lot what behavioral finance is. Behavioral finance includes the psychology, finance, economy, sociology, basically all to understand how we behave and how we have an emotional bias toward decision making. And there's different biases. It's actually a great book. It is the title, Psychology of Money,
by Morgan Housel.
Yes. I used that a lot to prepare for this podcast today. But it's a quick read. If you find this interesting, I suggest you go and download that book onto your Kindle and read it.
Well, behavioral finance is a more recent thing because it's showing, I mean, obviously money is a very emotional thing, so it's not making the most rash decisions sometimes. So it's really important to really understand your behaviors and how that's affecting your decision-making when it comes to finance.
Well, if it were just, dealing with the investment portfolio and matching it to an investment objective that an investor tells us they have, it would be really simple.
Right.
But people do have these bias. They have an emotional attachment to their own thought process. So this is where the job really gets interesting, in that we're dealing with people and their emotions and their finances and their biases all at the same time. Yeah. And the room gets a little crowded sometimes with all those different thought processes going on, in a conversation with our clients. But really, this is one of the most interesting topics about all of investments in finance.
It's always going to be an interesting conversation when the client starts off with, "I feel that," because then you just know there's no data behind it. Yeah. It's just that they feel. Yeah. They feel. There's no data. There's no Excel spreadsheet. It's just, "I feel like there's going to be a recession in 2021.
Oops. Yeah. Market's up 27%.
Yeah. They'll be right at some point, but you never know.
The Dow's at 12 or 13,000. I remember having conversations like, "Man, Dow's at 13,000. Like, it can't get much higher than this." Right. And here we are a few years later. So we have different biases. So these are all different, or these are labeled out. Conservatism bias is one. That can come through many different ways, but basically it's sticking to information with which you are comfortable with, relying too heavily on extending data or existing data versus new data, only sticking to markets the one knows very well, like CDs, right? Solely investing in domestic markets, not looking outside the U.S., things of that nature. Can create a bias toward being too conservative with investment picking.
Well, quite often we find that investors, come to us with portfolios of investments they'd bought in the past, and that the time that they made the investment or purchased the investment, they know why they did it, because they had a certain parameters of decision making around that. But data changes, the world changes, the economy changes, everything changes, and yet we often stick to that old decision making framework and continue to hold an investment even though there are better choices out there.
And we don't see this one too much because if you're overconfident, you don't need us, right? But there is an overconfidence bias that exists out there, placing too much faith in one's own abilities.
Tends to happen in rising markets.
Yeah, easy to do.
Yes, very true.
Yeah.
That's very true. Yeah, I never really thought about that. When the market goes down, that's when the phone rings the most.
Yeah.
Not from existing clients, but new people, just with their hands up in the air going, I give up.
Right.
I can't take this anymore. That's a good observation. But yes, basically believing that you have a leg up to other investors, you're smarter than other investors. We typically see this in younger people, or people that have a brother or a brother-in-law that's in the financial services business or something, and they're getting quote tips, all that fun stuff. So yeah, that's an overconfidence bias. When I see a lot is herd behavior. We see that in the market every day. Jeez. I mean, it's like, I feel like all the money just moves together. Oh, I went to bonds today. Oh, out of the entire market, went to cash today. And you see all the transactions that took place, right?
That's a lot of institutional too, but from the retail side, specifically now, think about Bitcoin, Tesla, and all these new hot stocks that you were talking about. Everybody's kind of chasing the herd mentality and wants to be a part of it. Don't want to miss out.
GameStop, right?
Yep.
Herd mentality is something we saw back a few years ago, especially in the 1999, 2000 timeframe, when people really became aware of the markets. And the ETFs and things were really coming online where individual investors could get involved. And as the market rose in 1999 with large cap growth as it did, people were just hopping on the bandwagon like crazy, especially in the OTC and NASDAQ marketplace. Mm-hmm. And we know what happened there. 2001, 2002, the market crashed, took a year. We had the entire lost decade for investments in these.
Buying .com companies that
That's
weren't
right,
even real.
the
They didn't
.com.
know what
That's
they
right.
were.
That's the word I was
Right.
looking
Yeah.
for. Yeah.
The other is confirmation bias. So that believes that we have a thought about something and then we find an article that supports our thoughts when both could be equally wrong. So that's, unfortunately, that happens more than you think because it's, man, I don't like this president. Oh, he's going to ruin this whole thing. And then there's some Facebook posts from a news source, air quotes here, news source that has nothing, not reputable at all, right? Yet reinforces that opinion. Oh yeah, this is all going to go to hell. I saw it. It was on Facebook.
Yeah.
Yeah. It's gotta be true.
Yeah, it's got to be true. So that confirmation bias is affecting your portfolio because you all of a sudden are going to go, oh man, I got to go to cash. I got to go to bonds. This president's going to just ruin all this. And it really, politics doesn't have a whole lot to do with investing, quite honestly.
No. We've had a lot of presidents in this country. We're still here. We're
Right.
going to be here.
Some perceived good by some, and
Some perceived not so good by others.
yes,
Yeah.
exactly.
Yeah.
Exactly. Especially in indexing. In active management, maybe you could tilt a style or something toward a presidency, I guess. But in passive management,
Right.
You're buying everything.
It just doesn't come on the radar screen.
Now, if one of them comes out and says they don't like capitalism and you can't create new companies anymore and you can't conduct business without government approval, we got a problem. But until that happens,
Right.
I'm voting for capitalism and hope the presidents just don't screw it up. But anyway, you can get confirmation bias that affects your portfolio as well. Another one, Matthews, you mentioned earlier, loss aversion.
Yeah, loss aversion came about from prospect theory, which was introduced by the Nobel Prize winner Daniel Kahneman. And that's really that a person feels twice as bad about $1 that's lost as the joy felt with $1 earned. So that goes back to really just trying to avoid losses, because that hurts more than what you're actually gaining.
Yeah. And that's why we determine a person's risk tolerance.
Exactly. So we'll gauge, how much a portfolio can decline in value through natural, process of markets, ebbing and waning, and to see where their pain point is. See where that twice as much pain that you talk about versus the joy of gain. So we'll find where that point is, and then build a portfolio around that if we need to.
Yeah, because the worst thing that can happen is they get out of the market at the wrong time because they're in a portfolio that they can't stomach, and then you would have been better off just being less aggressive the whole time period and just staying the course.
Yep. That's the important part, is just stay in the course. What happens, I think it was Carl Richards, an advisor in our field, became famous for writing these little Sharpie diagrams, and he has one that I actually bought off of him back when he sold those. I guess he still sells them. I don't know. But imagine a graph, going from left to right, and the graph starts off, with going up, and at the peak, it starts turning over on itself, and at the peak, we buy. We buy out of greed because, oh my gosh, the market's made all this money. I got to keep putting more money in, because all my friends, man, they've made a lot of money and I hadn't done anything. And then it starts going down, 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 gets to the bottom, and you sell. You sell out of fear. And then he goes back, and you see the chart. It goes back up again and kind of dot into the future, where it repeats itself. So you buy out of greed, you sell out of fear, and you repeat until you're broke. Right. And that's what happens so often. People with their 401k plans, brokerage accounts, oh man, market's doing really good, and they're going to put money in, they're going to buy. And then inevitably we have a 5-year cycle, market's down, and they go, oh, I'm not making any money in this, I'm out. And then they just lost whatever that percentage was. And other times they get busy and maybe they forget about it, but there's the rate of return that the market gives you, and then there's your rate of return. And usually that gap they call that the behavior gap. So that gap is why you need professional help in a portfolio, and staying the course and focusing on the goal and not focusing on the rate of return each day.
I think Warren Buffett has a quote for this. I think he said, buy when others are fearful and sell when others are greedy.
Yes, you need to do the opposite on that chart.
That's right. So he addressed that chart
exactly
through his investment style.
Yeah, I kept notes during the financial crisis because I figured something like that would happen again. I was a young advisor during that time period. And I tell you what, that's what I kept making a note to myself, is like, don't be fearful of these events, profit from these events. And that's where leadership comes in. And as advisors, we have to be leaders when the markets behave in wild, chaotic ways, because we have to be able to continue to point to the goal, and that we can get to the goal, but we're going to get to that goal faster. I mean, what do you mean we're going to get there faster? We're going to get there faster because we're going to take advantage of this situation. We're not going to be fearful and go to cash. We're going to rebalance our portfolio. We're going to take our losses and reinvest our losses or our gains in one side of the portfolio, which usually bonds in a time of crisis, right? Mm-hmm. And then move that over into the stock side so we can buy low. We did that during COVID.
We did.
And so it's not that, it's almost like you have to get angry about it and say, okay, this is the action. This is what we're going to do. It's a small thing. We're not going to go to cash. I'm not going to try to time this thing, right? But it's natural. All these reactions are normal human reactions. So when a client calls me and they're freaking out, I don't get upset that they're upset about their portfolio, because they're responding naturally. It's fight or flight, right? And they want to run. And they're telling me to pack up their stuff and run. And we're not running. We're going to stay here and we're going to fight through this, and we're going to get to the other side because we made rational decisions. And that's the part, that's the value that we add as advisors. The human nature, side, it makes sense. And honestly, behind closed doors, we're talking to each other like, man, what do we do? Should we go to cash? No, we don't go to cash, right?
We have healthy discussions, that's for sure.
But that's what we do internally, and we know what's right in the end, because in the end, it's the data. The data tells you what to do. We have decades of data to say, this is, if you did this during this time, you'd be fine, right? And we don't use leverage. So many people, they borrow money to invest. They do that by refinancing their houses or not paying off their house and leaving money in a brokerage account. And so it becomes more real to them when they see accounts dropping by 50%, and then yet, they still have this monthly nut, right? So you have to be smart about it. You have to be smart about it. You have to set yourself up for success, that a bear market will not steal your future. We had people retire right into COVID crash because we'd already planned for a COVID crash, not because of COVID.
No, but part of the process.
Part of the process is planning for some black swan event that's going to happen at your retirement. Can we still get you through it? And yeah, there was no problem. We had people calling up saying, don't send me my monthly withdrawal this month. Why? We've already planned for this.
Right.
It's been sitting in cash waiting on you. Oh, so I pull this out, it won't affect my return. No, not at all. All right. It's doing financial planning, making sure that you have enough cash on your side of the balance sheet that you can get through market turmoil. So it's planning and preparing for this situation. If you have all your money, you don't have any savings, and you have all your money in stocks and bonds, or in this case, probably stocks, and the market just completely falls apart and you're sitting there watching your balance fall, yeah, you're going to be scared. Why would you set yourself up like that? Why would you do that to yourself?
The returns were good at one point.
Yeah, it's greed.
Yeah.
It's greed. It's not thinking logically on how to construct a portfolio and how to construct your finances for success. So you want to build that buffer between you and the portfolio so that you don't do something stupid. I met a lot of people in 2010 with $1 million who used to have $2 million.
Yes.
You get my point?
Yeah. Back then they were calling it's your 401k turned into a 201k, if I recall. Remember that?
Right. That's right.
Right.
Yeah.
But there's a difference between a market event and a manager event. Now, we've talked about this in previous broadcasts where we say, look, when you're investing like in passive investments and you're investing in the index itself, then you're dealing with market events. Okay. Now, you could have a non-market event, but have a manager event if you're investing in active managers or an active mutual fund. Something could go wrong there. At that point in time, if something has gone wrong with your active manager, like in an active mutual fund, for example, you may need to make a change at that point in time. But if you're dealing with a market event and you're dealing with index funds, there's no need to make a change.
Right.
Right.
Well, if you have active mutual funds in your portfolio, you need to get a new advisor.
Well,
I mean, honestly, I don't. I have advisor friends. We meet once a month for breakfast, and they still have mutual fund portfolios. I don't get it. And
well, for those listeners who are on their own and they're investing in mutual funds, anyway, just be aware of there's two different kinds of events. There's manager event and
it's 2021.
Market events.
Probably, if you're an individual investor, you probably do have some mutual funds, and maybe you can't sell because of cost basis.
Big gains,
right? You have big gains. Hopefully, that's the case. But more so, you probably have individual stocks, and that's a whole different ballgame too. Because not only do you have to deal with market correction, you have to deal with, can that company rebound? Is there a problem with that company? You need to be looking at their balance sheets and their financials, right?
And there comes in, again, we'll go back to biases, what this is all about. You had a bias when you bought that investment. Now something may be gone wrong. Now, how does your bias overcome this? How do you correct your own bias in order to restart the investment process, to admit to yourself something's gone wrong? That's where we find biases come in very, very strongly.
well, we hear that a lot, hey, I bought this, but I don't know when to sell it.
Yeah.
And like, well, I don't know. I don't know when you sell that individual stock. Well, let's see if we can sell it. If we can't, we got to build around it.
Right. We still see, clients owning companies like GE and
Right.
AT&T, things that they bought years and years and years and years ago, and they just hold on to them forever. Maybe their uncle used to work there. Maybe their parents used to work there. Maybe they used to work there. It's not the same as it was 20 years ago. But these biases don't allow them to make a rational decision. It's very difficult. And our role, or an advisor the job of a good advisor, is to help them understand that bias and to recognize it, and that if it continues with that behavior, this is the likely result that you're going to see.
Yeah.
And we need to change that result. Therefore, we need to change and recognize the bias.
You also have to be careful advisors who take the easy road and they just liquidate the entire portfolio and they put you into their model. And so you got to be careful of that too. I mean, just because you have mutual funds and stock doesn't mean that you don't need to own those. It could be that it needs to be built around that there's a tax reason why you want to hold on to those. And I've seen it. I've seen. I literally sat in a training class at TD Ameritrade at one of their conferences on how to use this new system they just developed or just purchased, iRebow. And in the middle of that, this is why they're saying this is how you enter your cost basis into iRebow. So you have a new client that comes over. This is before SEC mandated cost basis transfer, right?
Mm-hmm.
This is how you update their cost basis information. And then literally a guy in the middle of the room goes, why would I do that? Like, I don't care what the cost basis is. Why do we need to enter that in there? And the room's just like silent. And finally another guy goes, well, how are you going to know if you should sell it? He goes, well, it's not in my model. I just sell it. Like, what if there's a huge taxable gain? He's like, well, great. You made money. And we're all just sitting there like, oh my God, the barrier to entry to financial services is so low. Like anybody can do it. And it shows sometimes. I actually have a knack for meeting people like that at conferences to the point where I almost dread going because I'm just going to be surrounded by idiots. But yeah, the point is that, one, there's more tax efficient ways you should be investing, but yes, there are biases and, I've always held this or it's a great fund. We had a family come in here that had a mutual fund that, they loved. They thought it was the best thing ever. Mm-hmm. And then I remember walking to your office going, hey, you know that mutual fund that was the best thing ever? It's like underperformed the S&P for the last decade. And that's its benchmark. Like that's its actual benchmark, right? We're not making that up.
Right.
And finally
once we pointed that out to them.
Yeah. They were like, oh.
But it done well, and that's all that they really thought about.
Yeah. Oh yeah, it's done well. Yeah, but did about half what it should be doing is the problem. So there was a bias there because Grandma told me this was a great fund, that it's a great fund. So yeah, you definitely have to keep an open mind. Because if I had to guess, people who are listening now would say they have no biases, but we all do.
Right.
We fight. We are aware of ours, and we fight those biases. Right.
Just got to recognize them. Going back to Brad's point too, what we've seen a lot of recently with individual stocks is kind of just emotional ties. Whether it be you worked at the company, so you want to have that still hold on to that stock, or you inherited the stock and your family member was in love with it, and you just have a hard time getting rid of it, even though it might actually be to your detriment to hold a big position of that in your portfolio.
You know what I found interesting? So women tend to be more conservative than men in their investing.
Mm-hmm. That's well documented. Yeah.
Yet they live the longest. So they really should be more aggressive in their investing because they have longer to go. Men tend to be more aggressive in their investing and more active. So they tend to trade more because they have this overconfidence bias, right? Yet their rate of return is less than that of the women. Think about that for a minute.
So women invest more conservatively for a longer time period and have greater returns
than men
who invest more aggressively for a shorter time that do.
Right, because they tend to be more active and have more biases.
More turnover.
Turnover, yeah. I thought that was interesting. It goes back to our last podcast on active versus passive and why it's just so much better to be a passive investor and focus on planning to overlay that. How do we overcome biases? I mean, I don't know that there's a bias-proof portfolio necessarily. I think it's a process that we just described. It's having enough cash between you and the portfolio that you don't have to go to the portfolio in times of an emergency, so that if the market behaves poorly, you don't overreact and go selling everything. That's probably one of the best ways to protect the portfolio or protect the portfolio from you, right? You don't invest your emergency fund into the S&P 500, right? Yes, we can build portfolios. We do this. I mean, there's really no reason for any of us to own bonds, but we own bonds because we want to reduce the volatility of the portfolio, right?
Right. It's to mitigate the risk of investing in stocks.
But honestly, it's the psychology side of money. So it's not doing it by yourself. It's having someone that you can talk through with. I feel like I repeat myself all the time with clients in times of, extreme volatility. And it's funny because I never want to be rude. I want to be very respectful in the conversation. And I do enjoy educating. So we get to the end of the conversation. They get, well, I know you said this last week when I called, but I just want to hear it one more time. And I get the biggest chuckle out of that. I just wanted to hear it one more time. I wanted to hear you say that one more time. Because I guess we're giving them confidence and our confidence. This is all going to be fine. Right. And I try to do that in our planning sessions. I know you do that in your planning sessions, Matthews. You show them this is bad timing.
Yep, you can show them not just the good timing, which everybody wants to really show.
Right.
You're not showing them double-digit returns every year. You're showing realistic returns and bad timing.
What is that? It's 17% drop is what we show them? A 17% loss in their money.
Correct. First year, double digits like that, and the second year, close to about 7-8%. So, sequence of return risk, you're retiring into two down markets, and the plan still works. So, like Casey mentioned, we're planning for this. So, as long as you're planning for it, that helps take out some of those rash decisions.
So, if the market rebounds, we get another one.
Not if, when, but
Or,
yeah.
when.
Yeah.
When it rebounds, we get another catastrophic event. So as long as we get the catastrophic event back, we get another one. If we only have one and it never rebounds, then we're still good.
Yeah, and we were talking about this earlier, the time frame of when you're invested, 20 plus years. A lot of people get to retirement and think they're done. They don't need to be invested in the market anymore. That's not really true. They might be a little more conservative, but they still need to have a larger portion of that in the equity markets through the next 30 years of their lifespan, from 65 to 95.
Yeah.
Inflation plays a big role there.
Correct.
Right.
In the book, Psychology of Money, from 1900 to 2019, they did an analysis. Actually, I'll come back to that one. That's a good one next, though. But the odds of making money in the U.S. stocks one day. That's a very short-term outlook. 50-50.
Maybe not.
You buy the S&P 500 at the open, I guess, and you have a 50-50 chance of making money that day. 1 year, you have a 60% chance of making money. 10 years, an 88% chance of making money. Over a 20-year, so far, 20 years, 100% chance. 100% chance. So every time you sell or you make drastic changes to your portfolio, you're messing with the odds of that 100%.
And there's going to be pullbacks. To those points, there's a 5% drawdown about 3 times per year, and there's a 10% drawdown once a year. And then the big bear markets of 20% plus are about every 6 years. So it's going to happen.
And you hear this in your planning. We talk about this. But people go, well, I can't be invested long-term. I retire in 5 years. When you retire in 5 years, that's not your portfolio is not retiring. Your portfolio is coming to work for the first time, right?
Yeah. not the early 80s. You're not getting double-digit returns out of the market and fixed income.
Hopefully you got to go 30 years, maybe 35. We plan on 35 years. If you retire at 60, we usually use age 95 in retirement planning. Your money's got to last for 35 years. how the heck is it going to last if you're abandoning ship or getting too conservative at the beginning of retirement? So it's your outlook is longer than you think it is. You know, retirement is a life event, is not necessarily a portfolio event, right? There's some things that we do to tweak it in retirement, as far as, you know, asset allocation and how much cash we carry, things of that nature. But it needs to work for you just as hard as it has, you know, saving up for retirement, right?
Well, in a retirement portfolio, that's its primary purpose. Like you said, it's
right.
It's first day on the job.
Yeah, exactly. It's born. Yeah. It's born. That's day one. All right. I like this example. Again, from the Psychology of Money, looking at time period from 1900 to 2019. Brad, you weren't born there in 1900, I don't think.
No, that was a little before my time. But I heard stories.
So you didn't know Sue, Jim, or Tom. But Sue, she just invests $1 monthly from 1900 to 2019. She lived a long life. Jim, he invests $1 monthly, but when the economy goes into recession, he sells everything and puts the money in cash instead on a monthly basis. And then when it's out of recession, he buys again. Okay. So he's
pretty good market timer.
Liquidates. Yeah. Well, I assume that they did this by looking at when recession began and ended.
Right.
So usually you don't know you're in a recession until the market's already down. You don't know you're out of recession until it's already up. Then Tom invests $1 monthly, but he waits 6 months into the recession to sell. That's kind of like that sell out of fear chart I described earlier, right? So Tom invests $1 monthly, but he sells 6 months into the recession, and then he buys again 6 months out of the recession. So he literally is buying at the lows and selling at the highs, or near there probably. So what happens from 1900 to 2029 or 2019? That's 1,428 months. 300 were recessions. So 22% of the time the economy was in a recession during that time period. Pretty small percentage when you think about over such a long time span. We know the answer to this, right? I mean, if you don't know the answer to this, you're not listening to the podcast or the last podcast for that matter. But Sue ends up with the most money. What I was shocked by was how much more. So Sue ends up with $435,000. Now, Tom, he was the guy selling in 6 months into the recession, buying 6 months out of the recession. He had the least, $234,000. And then Jim, who, you know, the fight or flight in him was all flight. So as soon as the economy was deemed recession, he was like, I'm out of here. 257,000. So 234 to 257 versus 435,000 for just putting your money in and just riding through the ups and downs.
Well, the reason the big difference is obviously compounded, but the fact that the biggest returns happen after those big drops, and you're not going to time it perfectly like Tom tried to do, and Jim even, and you've missed out on the biggest returns.
Yeah, definitely the data here is again, I assume he sold when someone from the Fed came out and said, we're in recession.
Right.
Yeah.
Time to sell. Yeah.
Time to sell.
Yeah.
So, yeah, I mean, if that's not a case right there of why you should be a passive investor and why you should be focused long-term, I don't know what it is. And to keep your cool. Just keep your cool, right? Say, you know, we had a sweet group of ladies. They passed away. They all passed away in the last year. But I remember during the financial crisis, I would go to their house. They didn't drive much back then. And I would say, Mrs. So-and-so, you know, this is your performance report over the last quarter, over the last year. And, of course, it was, 2007, 2008, beginning of 2000. It was terrible times to do portfolio reviews. It's just so depressing. And I remember them looking at me going, I'm not worried about it. You know, these are fairly conservative people, very conservative, actually. And so I'm not worried about it. Just like, okay. She's like, I've seen worse than this. I've seen the depression. So there's no food lines. You know, it all comes back. It goes down, but it all comes back. Just make sure I stay invested and keep reinvesting my dividends. And man, for a new advisor, relatively new, had 7 years of experience. What a great, they gave me such great encouragement that it enabled me to go encourage others who were about to jump off the cliff. Yeah. But it's, that's wisdom. And that's what we need sometimes, a lot of times in portfolio management, and just to have people in our lives that have wisdom, because there's all kinds of ways to get caught up in the chaos. We had a tornado warning watch. I always get this mixed up. There was a tornado in the area, whichever one that one is, and the sirens were going off, and it was supposed to hit our office here, and it was coming through Villa Rica, Georgia. And I go outside. I was like, is that the horn? So I open up my front door. I go outside, and I have neighbors that are just terrified of tornadoes, but they don't have a basement. And so about the same time I opened up my door, here's this family with the mama screaming at the kids, get out of the house, we gotta run. They're running down the street to a neighbor who has a basement, right? And of course, immediately that makes me go, oh, people are running. And I had a few Christmas things out in the yard still that have like metal stakes, large metal stakes. And first thing I thought was, okay, I probably have a few minutes. I probably should remove the large metal projectiles.
Take care of the Christmas decorations.
From the yard, yes. That's number one in my family. My wife has a lot of Christmas decorations. That's protected. So I pick up, it was just 2 items. I pick them up, kind of walk back inside, and I think, okay, I got to go to the basement. And I never go to the basement ever when that stuff, I pull up on my phone. I'll pull up 11 Alive on my iPad or something, and I'll kind of track it and make sure I don't need to go to the basement. But that's what happens when you watch financial news media and you watch all these, reports and friends, the water cooler talk, right? And they get you all worked up. Hey, you sold everything, right? You went to cash, right? And so all the herd is moving this one direction, and that's not what you need to do. We didn't need to go to our basement. Maybe we did, but we just needed to be calm and be ready to go to our basement. Yeah, just in case. You see, it's how you react to things. And so when you see that in your portfolio and you see Kramer and Susie Orman and all these people going, get out of the market, sell, blah, blah, blah. It's entertainment. They know people are tuning into their programs. Their ratings are going through the roof. They're selling more advertising during that time period. The people who did nothing, who maybe did a portfolio rebalance, who double checked their risk tolerance levels, those are the people that are the Suze, whatever her name was in my example here. Those are the people that make the money. And that's what our jobs are.
There's just more availability to the noise now with phones and iPads than there were then. So
that's
you just
right.
got to be
it's 24/7 news cycle.
You just got to realize what you need to be actually paying attention to and what you can block out.
Right.
Yeah.
I don't know. It's it's interesting that pessimism sells. Pessimism, it gets more attention. It motivates people to take action. Brad, next year in the market, I think it's going to be really bad, and you could lose half of your money, and that's going to alter your life forever. You won't be able to buy boats. You won't be able to pay those dock fees, Brad. And I have, Brad, you need to take this seriously. I have this newsletter that will tell you how to avoid this coming catastrophe, Brad. For $19.99 a month, I will tell you how to do this. I don't know what those things actually say. I've never actually subscribed to one.
Sounds good.
But it sounds great, right? Oh, I just buy this newsletter. This guy is going to keep me at the boat dock with my family.
Yeah.
Versus, Brad, markets go up and down. There could be a downturn next year, but we're just going to ride through it. That doesn't sound as good, does it?
No. I like the
You get a lot
other
of
story
viewers.
better.
You don't sell
Even though
advertising.
it was worse. I liked it better.
Yeah, right? Because people will gravitate to that. That's why
Yeah.
we're here about all the shootings and everything on TV, because that's, oh my God, somebody got shot.
Yeah.
So we have to be aware of that. And now it's worse because now it's, we can Trump proof your portfolio. Trump is going to take this market and totally bash it. That's what the extreme left says, right? Now the extreme right's doing the same thing. Biden's going to just, I think we all agreed that Biden doesn't know what the market's doing anyway. But the point is, it doesn't matter. You have to understand where it's coming from. Case in point, Brad, I read this long article in the Wall Street Journal about value stocks and how value stocks have to be in favor for this new year.
And guess who it was written by?
And I read it and I go, man, I wonder if Brad saw this. So I send it over to you. And what do you respond? What was your response to that?
The author was a small cap manager fund, a small cap value manager fund.
There you go. Understand?
I remember that.
Yeah. Understand where the news is coming from. Even the Wall Street Journal. Okay, this is a great article. Who wrote it? What was their intention?
Yeah.
Right? And they were wrong, by the way, because I think that was a year ago. I sent you that article.
I know. Small cap value was great.
They were really wrong.
Yeah.
And I'm starting to see it again now. Articles about, value is the way to go in the future. And then I read about it and I go, oh, I did it again to you also. I sent you that article. Who was that guy? Oh, I sent it to the whole advisory group. I sent the article about the hedge fund manager. The hedge fund manager saying that there's like a 30% chance in the next 5 years we have civil war in the U.S. What else was there?
It was terrible things.
Yeah.
Yeah. And it was a long article. I mean, he just went on and on and on.
But it was written in a major publication. It wasn't just,
No, you're right. So as you sent it to me, I was like, I read through that and I looked at the author and I looked up the author. Oh, he's a hedge fund manager. They make money when markets go down. They try to tell people at least that they're going to protect them on the downside. Well,
so if there's no downside,
why would people invest their money with?
So there's an agenda.
There's a financial motivation behind all of this media when it comes to financial advice. And keep in mind that they're not talking to you specifically because they don't know anything about your situation. They're just talking in general. They're answering a question that a listener may have sent in. Well, it's specific only to that listener, but it happens to be broadcasted to 10 million people.
Right.
And for 9,999,999, it may be the worst thing in the world.
We're sitting here in a media room right now at Weiser headquarters, and we have two TVs behind us, and they're both on. One's on CNBC, one's on Fox News, and they're always on mute. They're just because it looks cool, but they're always on mute.
Yeah.
Yes, occasionally I glance over and I see the price or where the market is occasionally, or there might be interviewing someone that I know or someone that's famous that I'm like, oh, what they're talking about. Warren Buffett being one of them. I always try to listen to those interviews. But yeah, it's a long-term focus. It's that 20-year game plan. And you get there one day at a time. And if you have portfolio anxiety, you probably need to there's ways to stress test a portfolio to say this is what would happen if the market went down by this much in your portfolio. There's easy ways to calculate that even without the fancy software, honestly. But don't look at it every day. You shouldn't be logging into your portfolios every single day. I don't know what the purpose of that is.
The reality is that a well-constructed, diversified portfolio addresses almost all biases. It's just inherent, okay? If you're loss aversion, a well-constructed portfolio includes bonds and cash that, protect against downside.
Right.
If you're herd mentality, well, if you're invested in index funds, that sector that's doing well is in the index.
That's true.
Okay.
You're always with the herd.
You're always with the herd.
Or majority of you's with the herd.
Exactly. So a well-constructed, diversified portfolio addresses almost all these biases. Once the investor gets into the portfolio, they'll see that everything that they were concerned about has been addressed in the portfolio itself.
Yeah, and honestly, I'll take that a step further to say that with active managers, they're doing you a disservice in the long term because they're not going to be able to keep up.
Right.
We just went through this percentages on the last podcast on the SPIVA report. It's produced every 6 months, but they're playing to your bias because it makes sense. It's good. It's good for business. Oh, market's doing this. We made these trades in your portfolio. Now, every now and then there should be a trade in your portfolio, but not every week, not every month, probably not every quarter.
That's not how you provide value.
No. We were closely following some BlackRock models a few years ago, and the BlackRock models started changing, like complete turnover quarter to quarter, to the point where like who's doing this with their money? It's not being a good steward at all, and it's built for those larger firms where they play to people's biases of we always have to be changing out funds, right?
Mm-hmm.
And it works because it works for them because they, instead of fighting human nature, they decided just to go with it, right? They're playing it as this is the value that we add in our relationship, and that's not what we're doing. We don't think the number of trades in the portfolio dictates our value and what we do here.
Correct.
So. Well, we could talk about this forever. I feel like bottom line is keep your cool, have a diversified portfolio, focus long term, but most importantly, have a plan. Like you need to have a plan where you've already built in all these worst case scenarios. Every single client here has a plan, every single one of them. We don't let anybody come into our firm without a plan. And if you don't have a plan, you focus first on what are your expenses? Keep 2 years worth of those expenses. Talking to retired people
right,
now.
Yeah.
Keep 2 years worth of expenses in cash. That gives you a 2-year buffer between you and your portfolio. Then it allows your portfolio to do more creative things as far as keeping up with inflation, be more focused on stocks and bonds. But even then, if you can't handle the overall stock market, add short-term treasuries to the portfolio, and that volatility will start coming out. Every 10% you add, it reduces the volatility significantly. So, great conversation, guys. Looking forward to the next one.
Thank you.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.